Hello, and thanks for joining us for the next installment of Bridging the Gap. I'm Lisa Kirschenbauer, founder and president of Omega Wealth Management in Arlington, Virginia. And joining me, as always, is Jared Jones, director of investments and lead advisor for Omega. How are you doing today, Jared?
Doing pretty well. Excited to be here.
Yep. Well, we got a couple of topics. We can't let go of this inflation conversation because clients keep asking about it. We're reading a lot about it. So we're going to talk a little bit about that today. We're also going to talk about things are opening up and people are starting to spend more. And this is a great time to talk a little bit about credit card usage, maybe some things that are shifting, sort of what's going on the landscape. And as always, what we've launched the show to do is to bring you different perspectives on money, the markets, and life. Whether it's the lens of gender, generation, or political orientation, we hope to inform, educate, and entertain you. So let's dig in, Jared. Yep, we can't let inflation go. Let's talk a little bit about some of the new developments there.
Yeah, so the main thing is earlier in June, inflation numbers came back for May for the 12-month period, so May 2020 to May 2021. 5% was the number. So that's pretty high. That's way above where we've seen over the past decade, hovering around 2%, even under 2%. Even with a little bit of deflation back in 2012, if I'm correct. So having it up at 5% is a little startling for people. The more interesting point in all of this, I think, is if you look at the bond markets, and a lot of people say that bond money is the smart money in the investment world. Those guys are crunching numbers and they're the geeks out of the bunch. They're not as gunslinger as the equity side, but the bond market, we're actually seeing yields on bonds fall. So that means bond prices are going up more or less. And that's the exact opposite of what you would expect to see in an inflationary environment. You would expect to see people leaving bonds. So inflation essentially means that the dollars that you have are worth less than they were at a previous point in time. So you would expect to see a bond bought for $1,000. When it comes due, you expect to get that $1,000 back and then the interest along the way. The risk in bonds is inflation makes that $1,000 worth, $900 at the end of the period. So in an inflationary environment, you would expect to see bonds not doing as well. To me, what I think, it actually makes me remember back to at some point last year, we kept seeing terrible job numbers come in and the stock market was doing really well. It's the exact opposite of what conventional wisdom would suggest would be happening. But I guess that's par for the course these days. We're expecting to see wacky things going on. To me, I think it really shows that investors, especially on the fixed income side, are trusting the Fed. When they say it's going to be transitory, they're not expecting it to be long-term. I think eventually we'll see inflation settle in at some point around 3% is most of what I'm seeing. Much smarter people than me project as far as where we'll end up long-term. So I don't know if you have anything else to add on the inflation front, Lisa.
Yeah, just a couple quick thoughts. One is just as a reminder to our viewers, when we're talking about bond yields, we're talking about the U.S. Treasury 10-year rates. We're not talking about short-term rates. So that's the Fed can control the short-term rates. That's what they've been doing. They don't control 10-year, 30-year out for the most part. Certainly the 10-year. That's when we think about the bond market and what's the bond market saying, we're looking at those 10-year Treasury yields. So that's just something to make sure that you're paying attention to the right thing. That's what we're looking at. We're also seeing, lumber's been ridiculously out of control from a price standpoint. Lumber's down, looks like copper has dropped. And so that's sort of interesting as well. There are other things because of supply chain and demand issues that are still going up. We have the shortage of semiconductors, but that's not inflation. That's like a supply chain problem. So, yeah, we've got a Fed meeting this week. We'll see what comes out of it. I know they're going to try to be pretty careful. We do have coordination really between Treasury and the Fed right now, trying to continue to manage rates and expectations. So yeah, I think we're going to assume that this is transitory. For clients that work with us, when we're doing planning assumptions, we're assuming an average of 3% inflation every year. Average means you can have higher, you can have lower. So we could have couple years of higher transitory inflation, and then and we've got lower years from the past, that averages out. So I think it's not worth it. I don't think we need to worry too much. It doesn't mean it doesn't hurt in your pocketbook, but what I think for the moment, we're betting on the Fed.
Yeah, they've done so well so far. They got us through a really challenging time, and I hope the Fed being in place is going to help us prevent, like we were talking before we started to hit record, prevent us from having a 1970s situation. That when we talk about inflation, especially if you lived through that time, that is something that you might anchor to when you hear 5% inflation starting to rise. It doesn't look like we're headed for that situation. There's a myriad of reasons. Maybe we can dive into that at a later time, but this is not the 1970s. There's a bunch of different factors at play right now.
Yep.
So the next place we wanted to go to was credit cards, a favorite topic of a lot of people, a lot of our clients, a lot of people in general love playing the rewards game. And as we're emerging from the long, dark winter that was the pandemic, we are seeing people are spending cash again more readily. So to take advantage of that, we're starting to see some interesting perks come out of it. This past week, Citi, who is a competitor of JP Morgan Chase and Amex on the credit card front, released a new card, or is going to be releasing a new card where it's going to give you 5% cash back on a category of your choice, more or less, depending on what you spend money on. So it will automatically, you don't have to select the category up front, whether it's restaurants, grocery, you name it, whatever your top category is by month, you will automatically get 5% back on that category. And then what the standard, I think 1% cash back on everything else. So that is to combat, I believe, Chase Sapphire and the stranglehold they seem to have in the rewards world. So there's a lot of factors at play. What are your thoughts on all of that, Lisa?
Yeah, so that I watch this pretty carefully. We both at times have followed somebody called the Points Guy. Highly recommend if you really are playing the credit card points game to check out their site, check out their blog. What I am seeing is the Chase rewards, like, you get 2 times on this or 3 times on that, are holding pretty solid. What's interesting is Amex during the pandemic was changing up what they were giving extra credit for, because they knew people were staying home. They were ordering Uber Eats or DoorDash or whatever. They were working from home. They were giving benefits or bonuses on different categories. And so now that's starting to shift. And so this is a great time to do a credit card review, credit card points review, is to, I actually carry a little cheat sheet in my wallet with my different cards of which one gives me the best on restaurants or gas or travel at CVS. And I use the cards appropriately and just pay them off. And so this might be a good time for you to just, if you haven't ever done that and you are playing the points game, to go online and just double check what you're getting bonus credit for. You may need to make some changes, especially if you've got some sort of automatic bill payment going to a certain card or whatever. But there's definitely some competition. I'm seeing the 0% offers come back again. And I think part of it is that now Amex is a whole different business model. They make more money off of the vendors or the businesses. They charge a higher fee than Visa, the Visa cards do. But I think, there's definitely some competition in that Visa space between Citi and Chase. To your point, Chase has sort of a stranglehold, although I don't know if you've seen, there's an Amazon Chase card, which you get points at Whole Foods and you get on Amazon, but now Whole Foods is rolling out their own card. So if you're a big Whole Foods person, you may want to make that change. Now, all that said, what we will always tell you is be careful about that. Every time you get a new card, that's a hard pull on your credit score. Also, you want to be careful about having, too many cards out there, and be careful about your utilization rates. You always want to, if you do have to carry a balance, you want to be under that 30% of the cards limit. Otherwise, that will ding your credit score. So, and for those of you checking credit scores, maybe a good time to revisit Credit Karma. So it's credit and then karma, KARMA.com. See where your scores are tracking. And, maybe this is a good time as, again, people are starting to spend more to just check, benchmark where you are and manage that going forward.
Yep, Credit Karma is a great tool. We recommend it to basically all of our clients. It will educate you and inform you on your credit score, which is great. But all the factors that go into it, like you mentioned, the credit card pool. What I typically see is when you have a credit card pool, it will last about a month, and then that will go away and fall off. But you don't want to have too many pools. The nice thing about Credit Karma, and we're not sponsored by Credit Karma or anything like that, although it sounds like it will tell you the ranges and the level of impact. So actually, I believe, I could be wrong, but Credit Karma actually suggests 10% utilization or below to get the best impact on your credit.
Yes, that's true. 30 is sort of the higher goal, but yeah, 10 is where you really get the juice, and it really helps your score.
Yeah, and that's just leading to the next point, especially with these rewards cards. If you do carry about, like, the magic happens when you pay it off every month. Don't spend money that you don't have. You're not the federal government, right? So if you're carrying a balance, no judgment. People do that. When you look at studies, about half and half, 50% of people carry a balance, 50% don't. But if you do decide to carry a balance, just realize that you're subsidizing all of the other people that are taking advantage of these great rewards out there. It's like, the dealers want to get you hooked on the drugs before they'll give you some free money or something, So just keep that in mind as you're using your credit card more often.
Yep. So, things are opening up. Obviously, it's we saw California open Disneyland and Universal Studios and all that. So we'll probably have some more conversation about this whole opening up trade and how it plays out. We're coming up on the end of the quarter. We'll probably talk more about that, because I think there's some interesting things continuing to happen as far as which sectors are leading. I guess, spoiler alert, looks like international is just a little behind the S&P 500. So whereas emerging markets is trailing. So going to be some interesting, I think, performance numbers coming as far as June 30th.
Yeah. All right, everyone. Thanks for tuning in. Feel free to like, comment, and be sure to subscribe to our YouTube channel. That's how you get these before anybody else can see them. So go ahead and do that. Until next time.
Take care. Great to see you. Bye-bye.